Hi, everyone. Todd Rosenbluth of TMX Vetify. And as you can see, I'm joined by Paul Biaki of SS&C Alps Advisors. Paul, how you doing?
Great. How you doing, Todd?
I'm doing great. So we're here in New York, but what we're seeing is investors are increasingly embracing international equity ETFs. What's going on this year?
Well, we're coming off a period of 16 straight years of U.S. outperformance of international markets. And a lot of advisors had moved off of neutral or to outright zero in their international allocation. Coming into the year, there was a case to be made for why the setup for international was perhaps compelling. You had a valuation spread between developed ex-US and the United States that was as wide as it's been in decades. And then on top of that, you had the anticipation that through policy or otherwise, that the dollar might start a meaningful period of relative underperformance versus the basket. And we've seen that start to play out. So you're starting to see advisors get back into international, maybe not all the way to neutral, but toward neutral. In some cases, maybe overweight to whatever neutral posture is, 10, 15% allocation. And that's led to pretty meaty flows. We've seen north of 120 billion in net inflows into international ETFs so far in 2025. 52 billion of that or so has been in developed ex-US strategies. So you've got momentum in the flow story, which I think is following on the relative performance story, which has been pretty compelling here in 2025.
So one of the ETFs that SS&C Alps Advisors offers in the international suite is IDOG. Tell me about that.
Well, IDOG is unique because it's not your typical developed ex-US strategy. It takes the 5 highest yielding stocks in 10 of the 11 GIC sectors in what the equivalent of IFA is and equally weights them. So what ends up happening is you have a mix of high yielding stocks or high dividend yielding stocks in that developed ex-US market, but you also have a very balanced sector profile. You have equal weight to those 10 sectors, meaning you have 10% in each sector, you have 2% in all of the stocks in each of those sectors. And it looks very different from IFA. IFA is 25% financials. It's got a long tail of developed ex-US banks, 55 to be specific. And what IDOG does is it avoids concentration in any given sector, certainly in any one stock, and allows advisors who are looking to generate yield and have a cyclical value orientation in that developed ex-US allocation to do so. And it's a product we've been talking a lot about to advisors here in 2025, partly because the outlook for international is somewhat improved, but also because if you look historically at the catalyst for strong relative performance from developed ex-US, it is typically the dollar. And once you repatriate returns from developed ex-US to the United States and the dollar is declining, that tends to be supportive of your US dollar denominated returns.
Well, thanks a lot for joining me. It's good to see you.
Likewise. Thanks, Todd.
If you want to learn more about IDOG and other SS&C Alps ETFs, you can visit etftrends.com. Have a great day.